Imagine you're running a giant machine that tells you one simple thing. How bad can this really get? In the years before 2008, a lot of very smart people on Wall Street had such a machine. It was built out of beautiful math, elegant models, and tons of historical data. The problem? One small assumption, buried deep in the math, was wrong. And that tiny mistake, about correlation, helped turn a housing slowdown into a global financial crisis. In this video, we're going to look at the 2008 crisis through a quantitative lens. My goal is to explain and visualize the concepts in a way that everyone can understand. So if you don't have a strong mathematical background yet, don't worry, you're still in the right place. Back to the topic. We'll walk through the framework: bonds, ratings, collateralized debt obligations, and mortgage-backed securities. Then we'll dive into credit default swaps. And finally, we'll see how a smart hedge accidentally left banks massively long risk, especially when correlation spiked and losses exploded. By the end, you'll see why misunderstanding correlation can be catastrophic, and how traders ended up short the thing that improved and long the thing that blew up. So let's start from the ground up with something simple: bonds. When a mathematician thinks about a bond, it's not a piece of paper, it's just a stream of future cash flows. To figure out what the bond is worth today, you take each future payment and discount it back to the present using interest rates. Add them all up, and that's your bond price. Here is the mathematical model of a bond, but for simplicity, we'll just go forward with this definition. A bond is a schedule of cash coming in, adjusted for the fact that tomorrow's money is worth less than today's. If you're interested in the mathematical details, I'll leave a link in the description to some material that I found helpful. Now, there are two important types of bonds in our story: Treasury bonds and corporate bonds. Treasury bonds, especially US Treasuries, are treated as almost risk-free. We assume the US government will not default on its debt. They pay fixed coupons and they're the benchmark for safe interest rates. Corporate bonds look similar on the surface: regular interest payments and a final principal payment. But here's the big difference: companies can go bankrupt. If a company fails, it might not pay you back in full. You might recover, say, 40 or 50 cents on the dollar, or less. So corporate bonds have default risk, and investors demand a higher yield to compensate. That extra yield over the Treasury rate is basically the price of credit risk. But most investors don't want to calculate default probabilities from scratch. That's where credit rating agencies come in: Standard & Poor's, Moody's, and Fitch. They put bonds into neat categories: AAA, AA, single A, triple B, so-called investment grade, double B, single B, triple C, and below. High yield, the polite term for junk. Now, think about insurance companies. They collect cash from premiums, and they need to invest it. Because they're systemically important and tightly regulated, they're usually allowed to buy only investment-grade bonds, often A-rated or better. So we have a structural imbalance: huge demand for safe, highly rated bonds, and limited supply of truly safe borrowers in the real economy. Wall Street looked at that and thought, what if we could manufacture more AAA assets out of riskier stuff? That question is the starting point for collateralized debt obligations, and eventually for the crisis. Before we talk about collateralized debt obligations, we need one more ingredient: mortgages. A mortgage is a special kind of bond. You make a fixed monthly payment. Each payment includes interest and a bit of principal. Over 30 years, your debt slowly shrinks to zero. There's no giant balloon payment at the end. This is called self-amortizing. The loan pays itself down over time. Now, picture not just one mortgage, but thousands of them. Banks and mortgage companies realized they could bundle these loans into pools and treat the combined cash flows as a big bond-like product. Investment banks then took this idea and formalized it into a structure called a collateralized debt obligation. The core idea of a collateralized debt obligation is pool a lot of risky assets, then slice the cash flows so that some pieces become very safe and others absorb most of the risk. Here's how it works. A special purpose vehicle buys, say, 100 risky bonds or thousands of mortgages. All the interest payments from these assets flow into this special purpose vehicle. The special purpose vehicle then issues different tranches, slices, of claims on those cash flows. At the top, you have super senior tranches. Below them, senior tranches. Further down, mezzanine tranches. And at the very bottom, the equity tranche, often nicknamed the toxic waste. The cash flows move like a waterfall. Coupons come in from the underlying bonds or mortgages. First, they fill the super senior bucket. Once that's full, they spill into the next senior bucket. Only what's left at the end reaches mezzanine and equity. What happens if some borrowers default and stop paying? The first losses hit the equity tranche. Then, as losses grow, they creep up to mezzanine. Only if things get really bad do senior and super senior tranches take a hit. This is where the magic, and later the disaster, comes in. Rating agencies looked at these waterfalls and said, the top tranches are protected by all the layers below. Losses will almost never reach them. So they gave many of these top tranches AAA ratings, even though the stuff inside the pool might be junk. In effect, 100 junk bonds go in, and you can create new, apparently AAA bonds at the top. The same idea was applied to mortgages. Residential mortgage-backed securities made from home loans. Commercial mortgage-backed securities made from property loans. To make them look safe and diversified, the mortgages were spread across the whole country. Some from California, some from Florida, some from the Midwest, Texas, New England, and so on. The logic was, if the economy in Florida suffers, that doesn't automatically mean Boston or Seattle will. So defaults should be only weakly correlated geographically. On paper, it looked like a beautiful diversification story. In reality, there was a new kind of risk building inside the system, subprime. To create all these residential mortgage-backed securities and collateralized debt obligations, you need raw material, mortgages. Mortgage originators, local banks, and brokers discovered something important. We can issue a mortgage and then sell it to Wall Street. We don't have to hold the risk ourselves. Once they realized that, lending standards began to collapse. From around 2000 to 2007, we saw teaser rates, very low introductory interest rates, sometimes as low as 1% or even 0%. Zero down payments, people buying homes with no money down. Interest-only mortgages. You pay only the interest, not the principal. Ninja loans. No income, no job, no assets. Loans issued with almost no real verification. In some cases, negative amortization. Your outstanding debt could actually grow over time. For many people, the monthly payment on these exotic loans was cheaper than rent, so it felt rational to buy a house even if the loan terms were dangerous in the long run. Demand for housing exploded. Home prices climbed almost continuously from about 2000 to 2007. This fueled more lending, more bundling into residential mortgage-backed securities, more collateralized debt obligations. It was a positive feedback loop. But teaser periods don't last forever. After a couple of years, many loans reset. The interest rate jumped from maybe 0 to 1% up to something like 7 to 9%. Monthly payments suddenly became much higher. For many subprime borrowers, the math flipped. Defaults started to increase. At the same time, housing prices stopped rising and began to fall. The borrowers in this segment, people with weak credit, little documentation, and risky mortgages, are called subprime borrowers. Their loans are subprime mortgages. From a modeling perspective, Wall Street had treated these mortgages as geographically diversified. But these borrowers had something in common that was far more important than geography. Very thin financial cushions. Very little true equity in the home. A strong incentive to walk away when things got tough. So when the environment changed, higher payments, falling prices, they tended to default together all over the country. In that moment, the key assumption behind many collateralized debt obligation models, low correlation of defaults, started to break.